Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts as they share with you the insider's guide to property investing.
All right, folks, you're on the Property Couch, the insider's guide to property investing. I'm Bryce, Holdaway, co-host of Location on Foxtel's Lifestyle channel, and he's Ben Kingsley, the chair of the Property Investment Professionals of Australia and the current Property Investment Advisor of the Year. Benjamin, how are you?
Very well, Bryce. Yourself?
Not too bad. Did you always get called Benjamin when you were in trouble?
When Mum was yelling at me, yes, I think that's pretty true.
I think that's probably the first time I've ever called you Benjamin, just quietly. How's your week been?
Look, I'm a bit depressed.
Oh, yeah?
Yeah. The footy season sort of over. I mean, look, trade bit is always an exciting part for us people who didn't make the finals. But yeah, other than that, life is good.
Well, that's probably the point where the female listeners thought it was really exciting. We're not going to talk about it, and here we are thinking, well, the trade part of the year is the most exciting part of the year.
We promised that through the summer months we won't talk, and I won't talk cricket because I can't stand cricket.
Oh, yeah, listeners, Ben is a red-blooded Australian male who doesn't like cricket, so I think you should hand him his passport.
Croquet, the 17th century, that's what cricket is.
That's
it's
hard to explain.
Game.
That's hard to explain, mate. But today we thought we'd, a couple of things. Major milestone for the Property Couch. We have hit over 50,000 downloads in 32 episodes. So, mate, from a little humble chat about whether we should bang on a bit about something that we know about, to now 32 weeks later, we've got 50,000. I don't know about you, but I'm pretty chuffed with that.
Oh, look, and the number one podcast for real estate property investing in Australia. Oh, look, it's your idea, mate, and I've just run with it, and I think it's a ripper.
Well, it was my idea to get you on. I think that was a very good plan of mine. I had someone from the UK, London, reach out to me and say, I'm loving the podcast. I actually get really frustrated when it ends, and I'm always looking forward to the next one coming. So I'm sure not everyone feels that way. The 2 out of 5 probably doesn't feel that way.
Just get on with it, I think is probably what they're saying to us. Stop pumping your own tires up.
But in terms of a sneak, or a bit of advanced information for our loyal listeners, our book is very, very close to hitting the stands. And it's something that's been a labour of love. It's been a few late nights, but...
a lot of late nights.
Looking forward to that hitting the stands.
Yeah, it's good. I think what it does is put frameworks and processes around, how we advise professionally. So it's going to be a great read, and it's going to be a great reference tool. So I'm really proud of it.
We'll give some advance notice to our listeners so you can get your hands on that. We decided that the bookstores were already full of property investment books from people leaning against Ferraris, telling them how good their portfolio is. So we decided we would use our own experience, but instead of making it all about us, it's about how we can help people make better decisions. Not too dissimilar to what we're doing on the podcast. Yeah. And
stop the mistakes and do the research, do the homework, line the ducks up properly, and then execute.
Geez, you've toned that down. It used to be stop people making dumb decisions.
Don't worry, I've got another idea for our next book. Yeah. Do you want to hear it?
Yeah, well, I'll hear it at the first time with the listeners here.
It's going to be called, this is the working title, You've left $100,000 on the floor over there. Do you want to keep it?
Do you want to get it back?
Yeah. It's just, just all about money management decisions that people make. But anyway, that's a story for another day.
What are we going to talk about today? Investing in a changing market.
Yeah. So I think it's important to understand that the property market works in cycles, and that within Australia there's markets within markets. We're a big advocate of this, and but if you talked about this 3 or 4 years ago, people weren't sort of talking about that. So it's now becoming the norm that most good commentators and people in property space understand that there are different marketplaces. And so what I wanted to talk about is when you are at the top of the cycle, what usually happens and what are good indicators about the top of the cycle. And the biggest one is usually the amount of supply that actually comes on. And I'm talking about existing stock. So what normally happens in a marketplace like this is greed gets involved. So there's people who own property looking to cash out of their property. There might be retirees or whatever, and they're thinking, I'll keep waiting, the market's still moving, I'll keep waiting, the market's still moving. And all of a sudden there's commentary and auction clearance rate starts, and then everyone starts to put their properties on the market thinking, oh, I've got to get it. So that's when you're at the crest of the wave before you start to see that. So they try to get in, but it's usually too late, because the leading indicators are usually a month behind or 6 weeks behind or whatever, where we start to see price change and price easing. So that's what you normally see in these changing markets. You see this rush of supply comes on, and that exacerbates the small correction that will occur because of that. And I think, in terms of the changing market, what we're also talking about there is the government intervention that's occurring through APRA and through the RBA via APRA to change those.
Yeah, I think you make some good points. I think the point too is that property investing has become a little bit desensitised, and what I mean by that is when I first started getting involved in property investment, it was back in 1998. I remember joining a group that got together to talk about property investment, but this was in the days before it was the Great Australian Barbecue topic.
Yeah.
So I was just thirsty to get amongst these people, and it was one of those things that not many people talked about. If you weren't within that group of like-minded people, you didn't talk to anyone about it.
Yeah.
Whereas fast forward now to 2015, everyone's prepared to talk about it. Everyone feels like they're missing out on the boat, and I think that's probably an important point because we've talked about fear of missing out. We've talked about the fact that people just want to buy an investment property, but in a changing market, people can make decisions now that have ramifications for them in the future, but they've got to get the decisions right now. And by that, largely, I'm talking about picking the right asset. And we see, and to this day, still amazed at the amount of flippantness that comes from someone picking an asset and picking assets, in our opinion, that aren't very good.
Yeah. Look, again, the classic case of coming down to education, and that is that an uneducated buyer will look at new and bling and think that, well, that's what a tenant will want, but they'll miss the wrong location. And you've always heard us talk about traditionally, or as a rough rule of thumb, 80% of the returns comes from the location you buy and 20% from the property, with the only exception to that is medium and high density apartments, because you can buy into those in a great location, but because there's no scarcity and there's potential for oversupply during the journey of changes to planning laws and so forth, you'll always have that challenge of that scarcity. So that's where, old flats and old apartments are obviously what we focus in on, and it's the existing stock that we focus in on. So people get mesmerised by this idea that the new tenant will want to move into something brand new, whereas tenants can also love living in the 70s and 60s and 80s blocks, which are a little bit tired, but they might save $50 or $80 a week, which can go towards their socialising and getting out there. Because at the end of the day, most of the tenants that are in these properties are the young professionals making their way, just leaving home.
Who value privacy and intimacy, because,
Correct.
I don't know if any of our listeners live in a big block or they've ever visited a really big block, but it can be a total fishbowl. You're sitting there on your lounge, looking at your television screen, you look out the sliding door there and you can see 20, 30 other living rooms. It's
and we're not comfortable with that yet.
No.
Owner-occupiers aren't comfortable with that. You go into Hong Kong, however, and all the major big cities around the world, and people are comfortable with that concept of being able to look at other people's televisions across the airway. So I think that's a message there. So we come back to this changing market concept. What we are fearful of is the amount of supply that not only comes on in markets that are peaking, but also the amount of supply that comes on from a off the plan point of view, and also house and land stuff. So when the market's moving so strongly and everyone wants to be an investor, and when we see 50% of all transactions happening to investors, there's problems with that story on two fronts. One is it just means that the amount of stock that's going to be mobilised over an 18-month, 2-year period is going to come online pretty quickly, and that's going to mean that there'll be an oversupply from a tenancy point of view as well. And people are paying a premium at that point because they think the market's moving and that's what they need to pay. So that's our biggest worry, and we've always said that, and we call it fool's gold. It's not the areas that or the types of properties that we would buy because of the ability to turn quicker supply on, and also poor timing of that. And I put my Pippa hat on now and I talk about sustainability of property investment industry. It's not great that there's going to be a lot of people who lose money in property over the next 5 years. It's just not going to be good for the industry. There's going to be government inquiries and why did this spruiker sold me this, and now it's worth X, and it's just going to be horrible. So
Current Affairs happy though because they've got
they're going to have
five
stories. They're going to have a
yeah.
bank of stories that they can run on it. So that's going to be the challenge where people are going to say, I bought this property in 2015 and I paid $650,000 for it, and it's now 2018 and it's worth $630,000. In fact, when it was finished and the valuer went in there, he valued it at $580,000. So it's going to be horrible.
Do you find that interesting though, when a client comes and tells you that story that you just described, and they go, I bought it for X and it's now worth less, and they don't have any what's the word? They're not sort of ringing up the advisor or the person who sold them the property and saying, you sold me. They're just sort of taking it on the chin. That advisor has now spent their $30,000 that they earned for that commission on a trip to Europe, but with no ramifications of that. And it's that sort of the investor. I said it in a video. It's got to be a team sport.
It's a shame. It's a shame. They're being called out, and so. Of the ones we get to see is probably 1% to 5%. And the same as of people who contact PIPA and want to make a complaint about the spruiker or the advisor who sold them something, who usually more often than not aren't members of the association, and they want some ramifications on them, as opposed to, that probably 80% of them who say, all right, well, we stuff that up, and then don't go and invest again and think that property investment's a dog. That's the big challenge in a changing market, is especially in Sydney and Melbourne, where we're certainly close to the peak in Sydney and probably not far off it in Melbourne. But I was in Sydney last week, and it is a thriving. It's the economy's moving really well. I've got to compliment Mike Baird and his team. He's basically put confidence back into the economy. It's got a good pipeline of infrastructure projects, and so we might be calling the market as done, but I still think there's probably growth in it, but just not at the heady levels that we've seen. So if you're still trying to get into the Sydney market, with the supply coming on now, you're really going to know between now and sort of the autumn selling season, it's probably going to be your best opportunity, because I don't think interest rates are going to go up anytime soon. I actually think that, if anything, there could be some scope for interest rates to drop.
Interesting, because we'll talk about that later in terms of whether or not you think the banks will pass that on. But when people come and make the complaints to PIPA, it's very difficult for. I'll take your feedback, but it's very difficult to have ramifications back to the advisor. Comments, because the sad thing for property investors is caveat emptor: buyer beware.
Correct.
And there's no regulation or rules that they're actually not following because they don't exist.
Well, look, good point. So these companies, there's a few ways in which their modus operandi are usually outbound call centres or seminar room type discussions. Then you have a series of people that you meet on the journey. So it's you get someone in your home that comes and does the initial presentation, and within sort of 10 or 15, within sort of 3 hours, you're supposedly an expert at doing it. They've taught you everything about it. They've flavoured every part of the conversation to a set, so for those naive people whose level of financial literacy are low, they think it sounds good, they're going to get a tax break, they've got equity in their home. So that first person comes in, then they get introduced to the lender who's going to put the deal together. So I think a lot of it, and I'm sure you've had experience with this as well, is when they go back, and if they do try and go back, one, they don't exist, or that advisor's moved on. He's moved company, and so he knows that I don't even like the word advisor. That
the listeners can't see me do the inverted commas with my fingers, can they?
That marketeer who is incentivized heavily through a huge commission is just going to move on to the next opportunity and and that's the disappointing part. So the people who work with professional advisors who don't have an agenda, don't have a set strategy, can be across multiple strategies, and do the classic asset selection correctly, will hopefully see their clients get a better reward over the longer term.
These guys know that we're motivated by fear and greed, and one of their classic techniques, for the benefit of the listeners, is what's called disturbing. And they walk into someone's house, get them very emotional about where their position is, and they purposely disturb them so that they feel all of this fear around not having enough. And they know that once they've got them at that emotional place, that's when they strike to kill. What I find is really interesting is when someone comes and talks to me and they say, look, I'm talking to XYZ and I give them some...
Doing some research? Are they checking out a couple of companies?
No, even to the point where let's call them a spruiker, has got them lined up for 2 properties.
Right.
And I talk to them and I give them some of our independent advice. Sure, for the benefit of the listeners, we run a commercial operation here. We're not totally agendaless, but when we're talking to our clients, it's our job to demonstrate value and then deliver that value.
Yep.
So if someone buys into the message that we have, it's interesting because I've got a relationship with that person now. It's interesting when they ring me and they go, Bryce, these guys are ringing me and they are hounding me and I've told them I don't want to proceed and they will not let go. Yeah. And it's just amazing the harassment technique. They're their friend at the beginning, telling
mates.
them, the best thing since sliced bread is their product, but at the hint of not wanting to go, oh my God,
they're
they
seeing
turn
$50,000 fly
quickly
out the door. There's $25,000 in each of those properties I've just sold you. So come on, what's wrong with what
they've already booked their ticket to Europe on that sale. So
look, and these people can make an unbelievably big living. They could be taking home 7-figure livings. Yeah. The really good communicators, and unfortunately, the reality is that if the asset doesn't stack up and the client doesn't have a performance, I always talk about it. Let's go and buy the milk bar or the corner store, and let's go and pay $500,000 for it. Because this is what they're promoting. And let's run that $500,000 business at a loss for the next 5 years, maybe 10 years, and then let's sell it for $1 million, or it's going to be worth $1 million after that. Now, no corner store business milk bar is ever going to be worth that amount of money. So, and that's what they're promoting. They're promoting that bricks and mortar is a safe investment, and sensibly it can be a safe investment, but not every asset is going to be that right asset to buy.
The unshakable belief that people have that all property will double in value no matter what is the biggest mistake anyone can make. Because sure, historically properties have doubled, but it's the average. It's the pool. Yeah. And to get the middle point, some properties have to perform really poorly, and some have to perform really exceptionally. So
it's a good point, mate.
Don't have that unshakable belief that just putting your name on a title is all it's about, because it's not.
And I think I was listening to Roger Montgomery this week, and Roger's a value investor. He's in the share market, and look, I like a lot of things that he says. The fundamental analysis that he uses is proven. It's based on Warren Buffett's sort of work that he's done through Berkshire Hathaway. So I like it a lot. And he made a really interesting point about if a retiree has $1 million at the moment sitting in the bank in a term deposit, they're earning 2.4% for their money. Now that's $24,000 a year on $1 million invested. That's below the poverty line. So they're obviously got to move up the risk chart to try and get a better return. So by that, they mean chasing better returns requires higher risk. And so when they're doing that, there's a lot of people moving into bricks and mortar because they're sort of saying, traditionally I'm low risk and good, and you should be thinking that as well. The last thing you want to be doing in the age of 55 onwards is risk the farm. You don't want to be making aggressive decisions about getting a fast track outcome, because more often than not, you'll burn the cash as opposed to build the cash. So I think from that point of view, it's a natural thing. Sitting there going, I always thought that my money would get me at least 4 or 5%. That's 40 or 50,000 a year, whereas it's getting me 2.4%, 24 grand a year. So I suspect there's going to be more people moving into the bricks and mortar space, and that's where it comes down to borderless investing and timing the cycle.
Getting the asset critical. If you think about the AFL Grand Final, mate, just throw the sport analogy in. There's 100,000 people piling into the MCG, but just because everyone's wanting a seat doesn't mean that that's where you want to sit. You want to sit in the MCC members. You want to sit in the Ponsford stand. Yep. You want to be in the blue chip areas of the MCG, and it's no different.
You don't want to be in the nosebleed seats.
Where you're in the sun on a 32 degree day. So just because the crowd is coming doesn't necessarily mean you just put your name on a title, and that is it.
Very good. Very good. So what else has been happening in a changing market? What do we normally see?
Well, we've been talking to our team here around lending, and APRA is in control, and this is more your area than mine, but APRA is in control of the larger banks. So we've been talking to clients about going to second tier lending to be able to get themselves opportunities to lend. Thoughts?
Yeah, well, look, so basically APRA's put a handbrake on the big banks around how much investment lending they can do per annum. They don't want to see the investment loan book grow by greater than 10%. So I think it's a better move than a blanket banning LVRs up to 90%, which was seen in New Zealand occur. I don't think that was successful at all. And we do applaud again APRA for putting in some regulations around assessment of borrowings. That has upset a lot of investors because, sophisticated investors who know that they can afford to buy that next property aren't able to do that because of that blanket ban on the main lenders. So they're going to be looking for alternative funding. And so second tier lending or private lending is going to be part of that because that falls outside of the Australian Prudential Regulatory Authority's responsibilities because they may not necessarily be a licensed lending institution. Or deposit-taking institution in some cases. So that's just going to be something that you need to look at. You need to speak to, as you always say, a sophisticated and experienced mortgage broker who understands investment lending, and it's all they do. If they specialise in that area, you're going to do well. They will continue to look for options for you. But you just got to think outside the square. For those of you who have got really high LVRs, and you're trying to be super aggressive, look, a word of warning. Property is a long-term investment. Yep, things might be going really great for you, but that's because the property market's been performing well. Don't go too hard all the time. You will get caught out. And when you get to that sort of level of high gearing and you haven't done your cash flow analysis properly, things can fall over, and you won't just have to sell one because you're so highly geared. You potentially have to sell a lot, and then you work out how much it costs to get in, and you're going to see a sea of red. So
if you ever want to sell, you want to sell from a position of strength,
correct,
not a position of weakness, and that's setting up for a position of weakness. I had a client say to me the other day, if there's an oversupply of apartments, why doesn't the government stop giving development approvals on these big high-rise? And the biggest challenge is it's political because it creates so many jobs. And particularly in our state here in Victoria, where manufacturing is being affected hard.
Yeah.
So it's this delicate line between, okay, they keep putting, weapons of mass construction up in terms of cranes in the sky, but there's people offshore buying them. It's creating jobs. It has a massive multiplier effect on the local economy in terms of brand new versus established property. And essentially that's the, the bigger picture reason why.
Oh, look, political and economical. I mean, ultimately, it's foreign investment that we're chasing. And if we get that foreign investment, I've said this before on the podcast, but any dollar that comes into Australia, and we've had to produce very little for it, is straight to the bottom line of GDP. So that type of foreign investment is critical for the future growth of our, economy. And I mentioned this in the RBA video that I did this week, talking about where our opportunity lives. What we do need to ensure that this oversupply is kept within reason, because they will build them, is foreign students and opening up our immigration laws, because now that the dollar's low, it's going to be very attractive for international families to send their children here to do work. And, that dollar basically means on a world scale, our living standards have gone down, but locally we don't see it. But when we travel overseas, you're definitely going to see it if you're off to Europe or the States. So there's a big message. We're going to see this tourism dollar come in. We're going to see the foreign student money coming in, and they are the people who would more than likely pick up the slack. And they're used to living in high density cities. So city locations, they don't want cars. Their parents won't want them to own cars. It'd be very hard for them to get a license here. So proximity to all the things they need, the universities and so forth. So you're going to see a bit of a real boom in student accommodation. Student degrees in universities. The visa stuff coming in, and that's great. That's a good news story for us. We need a growing population for our survival as a nation, and a lot of people don't get that.
Yeah, I agree. That's the property professor when we were over in Adelaide talked about that too, in terms of a lot of international families are looking at Adelaide because they want their kids, they don't care if their kids go to Melbourne or Sydney because to them, perception is it's not as safe as being in a place like Adelaide. So that's where a bit of that money can flow into states that are traditionally not seen as the golden children of Australia. Interest rate cuts. That's the biggest thing that. So they kept the cash rate on hold this week.
Yes.
And any talk of future interest rate cuts, you've got a theory around whether or not that will be passed on to the lenders.
Yeah.
To stop a property-led boom from the consumers.
Yeah, so when you get low cash rates and when you get low cost of money, naturally the flow-on effect of that is asset appreciation. Because money's so cheap, it makes buying assets look cheaper, and so that creates demand and it fuels a value appreciation. And that's what we see not only in residential but also in commercial activity. So when you see that type of event occurring, the RBA is saying it's got to be within a reasonable level. I mean, if we have a property correction and a severe property correction, we already know what it looks like in Ireland, in Iceland, in the UK, and also the biggest one of all, America, in terms of what actually happens when you have that impact. It just destroys the economy. So the fabric of our economy and the value of wealth is all in residential property. I mean, I'm just trying to remember how much it is, but I think it's around almost $6.2 trillion now of our wealth is in residential property. So the RBA is going to say to the banks, here's another rate cut if we need it to obviously make their jobs easier. But I suspect they're going to put some limitations around residential interest rates and try and allow business the opportunity to have access to slightly cheaper rates. So at the moment, commercial lending rates in business will be floating around 7-8%. If you're talking about a rolling bond, probably around 9 or 10%. So if that can come down to 5s and 6s, which would be amazing, it won't come down to 5s or 6s, but let's say 6.5, 7. All of a sudden, if the business needs to go and borrow $5 million for an expansion project and to employ 20 more people, that's where we hope to see, because that's what we need. The residential side, the construction side of residential, we've done some good lifting. There's been really good dwelling approvals, but what we need to see is more work done from the businesses. So come on, businesses out there, get out there and have a go.
Yeah, the consumers would need to see the big picture of that too, because they'll be probably dirty that they don't get the rate cuts passed on. But if it means can create more jobs and the jobs become more secure and we don't move into two quarters of what is for recession? Two quarters of negative
GDP. That's all it is.
So the bigger picture, which is the invisible,
yeah,
needed to be made visible. So,
correct, because our terms of trade are pretty ordinary at the moment. You know, where our mining boom is slowing. There is an oversupply of resources around the world that's affecting the values of those resources. So ultimately, we need to see it come through another way. And I think what we've got to look at is our domestic economy and again, open the doors for immigration to try and bring people in to fill the supply, because everyone's still saying there's jobs out there. But the reality is from that point of view, we've just got to have a go and we've got to keep that sentiment strong. We can't be negative, because negative sentiment will result in that R word.
Have a go. I like it. Sounds like a good theme for the economy. But we've covered a fair bit of stuff. Investing in a changing environment. We've talked about the type of property, overarched by fool's gold. Don't get fooled by the wrong properties in a boom time, because you really need to be thinking about what properties will perform over the long term rather than just in the short term. We talked about a couple of things regarding lending. We didn't really get to talking about fixed versus variable. We'll keep that for another podcast. But talk to your investment savvy mortgage broker about second tier lenders, because that might help with your borrowing capacity. Ben talked about shares and how lots of people are looking to have their money move out of a lower cash rate environment, seeing shares as volatile. So more people will move into the property market. So don't just join the crowd. Make sure asset selection is pretty strong. And of course, we talked about interest rate cuts and whether or not that would be passed on to the consumers. So watch this space for that. This week, the Reserve Bank did leave the cash rate on hold, as Ben does every month. He puts out his commentary around that in terms of the Reserve Bank's decision. So if you go to thepropertycouch.com.au, that will be up there this afternoon. So you can check that out. It goes for about 7 or 8 minutes, and it's well worth the time listening to. A couple of podcasts ago, I did the common mistakes that people make. So our producer, Ivis, has put that up on the website for you also. There's the 7 common mistakes, so you can check that out. And just to celebrate the fact that we've hit 50,000 downloads, if you're one of our listeners who does enjoy our podcast each and every week, I wonder if we could ask a favour. If you could just tell one friend about the podcast. Tell them you've been enjoying it. Show them how to subscribe to the podcast, which for some people they've never done before. So if you are enjoying it, if you could tell just one friend.
Because what's in it for them? They won't make tens of thousands of dollars worth of mistakes.
You toned it down again, mate. They won't make a dumb mistake.
Yeah, they won't make a dumb decision when it comes to investing in property.
Exactly. And the last thing is, for those of you who have joined our podcast family in the last few weeks, very early on we put up a link to a webinar that Ben and I did that sort of goes through a lot of the, I guess, foundational things that we've been talking about here on the podcast and how we bring it all together. So if you're new to the podcast and you haven't checked out that webinar, it's free. Go and register for that. Ivis will have that up on thepropertycouch.com.au also.
Beautiful. So that's it.
That's it. We're done. Facebook,
Time
Twitter,
flies when you're having fun.
Instagram, the usual
All the
at
plugs.
the Property Couch handles. That's where you find out first. So, mate, again, this is the point where everyone is just waiting with bated breath to see if you've done your research.
I think this is
on.
dying of a slow death. I think once we finish up at Christmas time, we might sort of just go off to a standard sign-off. I've got to go and do research, and I don't like doing it.
So where we go?
Polish.
Polish, folks, you're about to hear it. Until next week, we'll see you.
Narazi.
There you go, folks. See you later.